Welcome to StockTok's deep dive into Emerson Electric. Emerson Electric is a global industrial technology company that designs and manufactures automation software, precision instruments, and process control systems for industries ranging from energy to life sciences. At the time of recording, the stock is trading at 146, sitting meaningfully above both its 50-day moving average of 141 and its 200-day moving average of 136, a constructive technical setup. The 52-week range spans from 95 to 165, placing the current price in the upper half of that range. The 14-day RSI, a momentum indicator, reads 62.4 neutral territory, neither overbought nor oversold. Let us work through the fundamentals, scene by scene, starting with a quick business overview. Emerson Electric's core revenue engine is industrial automation. The company sells process control hardware, software platforms, and measurement instrumentation to capital-intensive industries. Its competitive moat, in our view, rests on deep customer integration and high switching costs. Once Emerson systems are embedded in a refinery or pharmaceutical plant, replacing them is operationally disruptive and expensive. The StockTok score stands at 43 out of 100, signaling caution. Valuation scores 0 out of 20, health 15, profitability 12, growth 8, and smart money 8. The data paints a picture of a high-quality business trading at a price that demands scrutiny. Now, valuation. The question every investor has to answer: are you paying the right price? On a trailing price-to-earnings basis, Emerson Electric trades at 35.78 times earnings. That is a meaningful premium for an industrial company. The forward price-to-earnings ratio, which reflects next 12 months' consensus estimates, compresses to 22.51, suggesting the street expects earnings to grow materially from here. The PEG ratio, which adjusts the price-to-earnings multiple for the underlying growth rate, stands at 2.13. A reading above 2 typically suggests the market is pricing in optimism that the growth profile alone does not fully justify. The EV to EBITDA multiple, a capital structure neutral valuation gauge, sits at 19.01, elevated relative to where diversified industrials have historically traded. The price-to-sales ratio of 4.55 further reinforces the premium narrative. Guru Focus Value, an intrinsic value estimate derived from historical multiples and growth, sits at 125.80 at the time of recording. With the stock at 146, the implied margin of safety is negative 16.34%, meaning the stock trades at a premium to that estimate, not a discount. Wall Street analysts, at the time of recording, have a consensus mean target of 164 across 27 analysts, with the high target reaching 205 and the low at 104, a wide dispersion that reflects genuine uncertainty about the growth trajectory. The next earnings report is due May 5th of next year, with the street expecting earnings per share of approximately 1.54, ranging from 1.50 on the low end to 1.58 on the high. That report represents a near-term catalyst worth monitoring. Market sentiment around Emerson Electric, as of the creation of this video, is neutral, with insufficient recent news flow to tilt the scales either way. Peers in the process automation and industrial technology space, companies such as Honeywell or Rockwell Automation, have historically commanded premium multiples given their recurring software and services revenue. But in our view, the current setup warrants a degree of caution until growth re-accelerates meaningfully. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist that evaluates profitability signals, leverage trends, and operating efficiency improvements, comes in at 7 out of 9. That is a strong reading. It indicates Emerson Electric is passing the majority of fundamental health tests. The Altman Z-score, a model designed to assess the probability of financial distress, registers 4.30. Any reading above 3 is generally considered the safe zone, so Emerson Electric clears that bar with meaningful headroom. Now, the nuances on the debt side deserve attention. The cash-to-debt ratio of 0.13 is low. The company holds only 13 cents in cash for every dollar of debt on the balance sheet. That is a constraint, not a crisis, but it does limit financial flexibility. Interest coverage of 6.70 times, meaning operating income, covers interest expense nearly 7 times over, is adequate and speaks to manageable debt service. The current ratio of 0.84, which measures the ability to cover short-term liabilities with short-term assets, sits below 1, suggesting the company leans on its operating cash generation to meet near-term obligations rather than a cushion of liquid assets. Debt to equity of 0.69 is moderate. In our view, this is a financially sound company, but the relatively thin cash buffer is a line item worth watching as rates remain elevated. Next up, profitability. Is this business actually making money efficiently? We begin with return on invested capital, the single most important metric for evaluating how effectively management deploys the capital entrusted to it. At 6.98%, it is positive but underwhelming for a business trading at a premium multiple. Industrial companies with durable competitive advantages typically sustain return on invested capital well above their cost of capital, so this number is one the market will want to see improve. The gross margin of 52.76% is genuinely impressive for an industrials business. It reflects the value-added nature of Emerson's software, instrumentation, and engineered solutions, products that command pricing power because customers depend on their precision and reliability. The operating margin of 19.87% demonstrates that the company converts that gross profit into operating income with discipline. Overhead and operating expenses are well controlled. Net margin comes in at 12.71%, and free cash flow margin, the percentage of revenue that converts into actual distributable cash after capital expenditures, stands at 14.16%. That free cash flow margin is particularly meaningful. It tells us that the earnings quality is real, not a ledger abstraction. The profitability profile, in our view, reflects a high-quality industrial franchise. The key question is whether that quality is already fully reflected in the price. On to growth. Is this business expanding, and at what rate? Over the trailing 3 years, Emerson Electric has delivered revenue growth of 9.3%. That is a solid number for an industrial conglomerate, suggesting the company benefited from capital spending cycles in its end markets, energy transition investment, automation demand, and reshoring of manufacturing capacity. Stepping back to the trailing 5-year view, however, revenue growth moderates to 5.5% annually. That deceleration is worth acknowledging. It suggests the more recent growth rate may reflect a period of above-trend demand, rather than a permanently higher structural trajectory. The book value growth over the trailing 3 years is a striking 27.2%, which reflects balance sheet expansion, potentially driven by acquisitions, retained earnings, and portfolio restructuring. Emerson Electric has been actively reshaping its business through divestitures and acquisitions in recent years, which can inflate book value growth in ways that do not always translate directly into earnings power. On dividends, the company offers a yield of 1.48% at the time of recording. That is not a high-income proposition, but for long-duration industrial holders, the dividend signals capital discipline and a commitment to returning cash. The growth setup, in our view, is constructive but not exceptional. The market appears to be pricing in a re-acceleration that the 5-year trend does not yet fully validate. Now let us talk smart money. What institutional capital is actually doing with this name? 13 top-tier investment managers, the kind of concentrated, high-conviction funds that institutional allocators track closely, currently hold Emerson Electric in their portfolios. That is a meaningful signal of quality recognition at the institutional level. However, the directional activity tells a more cautious story. Among 13 F-filers, institutional investors managing over $100 million who are required to disclose their holdings quarterly, only 10.5% are currently net buyers. In the framework we use, A reading above 50% would indicate broad institutional accumulation. At 10.5%, the data suggests that the institutional community, in aggregate, is not rushing to add exposure here. Looking at the specific Guru holders, Jensen Investment Management holds the stock at 0.16% of its portfolio, but has recently reduced its position by 18.5%. Tweedy Brown, the value-oriented New York manager with a long track record rooted in the Graham and Dodd tradition, also holds the name at 0.10% of its portfolio and has trimmed by 2.67%. These are not panic sells, but the reduction direction from two respected managers is a data point worth incorporating into the overall picture. Insider ownership stands at 1.47%, a low figure, meaning the management team has relatively limited skin in the game relative to what we would ideally want to see. Over the most recent 3 months, insiders recorded 0 purchases and 4 sales. Insider selling in isolation does not always signal bearishness. Executives sell for personal liquidity reasons. But the combination of 0 buys alongside 4 sells, with already low insider ownership, reinforces a cautious read on the smart money dimension. The weight of institutional evidence, in our view, does not currently suggest a broad-based accumulation phase. And finally, the verdict. Let us bring it all together. On valuation, Emerson Electric scores 0 out of 20. The stock trades at a meaningful premium to its Guru Focus intrinsic value estimate, carries elevated price-to-earnings and EV/EBITDA multiples, and in our view, leaves limited margin of safety at current levels. On financial strength, the Piotrowski and Altman scores are reassuring. This is not a fragile balance sheet, though the thin cash-to-debt ratio and sub-1 current ratio are constraints we would want to see improve. On profitability, the franchise quality is genuine. A gross margin above 52% and free cash flow margins above 14% reflect real pricing power and operational discipline. On growth, the 3-year revenue acceleration is encouraging, but the 5-year trend moderates meaningfully, and the market appears to be pricing in a growth reacceleration that must still be demonstrated. On smart money, institutional accumulation is thin. Insiders are not buying, and 2 respected managers have trimmed their positions. Collectively, this warrants caution in our opinion. The overall StockTok score of 43 out of 100 reflects a high-quality industrial business at a price that, based on what we see, asks investors to pay for a future that has not yet fully arrived. One might argue the case for a more attractive entry point at a wider margin of safety. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on Emerson Electric. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.